Welcome all. Here I am going to discuss about capital structure of a company. Before going to capital structure, we want to study about financial structure. Okay, as all we know, the capital is must in every business organization for the smooth operation and running. There are many ways to raise capital, such as borrowing fund from financial institution, using their own capital that we can call the owned capital or equity capital, then preference capital, etc. Mainly, we can classify three major sources that are debt, preference capital, and equity capital. We already learned about cost of capital. While selecting the source of capital or mix of capital, the company or business organization must ascertain the cost of that capital. Every business organization tries to raise capital which has minimum cost. Here, the mix of long-term and short-term fund employed by the firm in order to procure the current as well as fixed asset is called financial structure. It refers all the items on the liability side of the balance sheet. Okay, it refers the all the item on the liability side of the balance sheet. It includes both long-term and short-term funds. So, capital structure is the part of financial structure. Capital structure is the part of financial structure. It refers the composition of long-term funds only, which are used for the long-term operations of the business. Under capital structure, all the item on the left side of the balance sheet except current liability. All the items of the left side on the balance sheet minus current liability or except current liability. That item we can call capital structure. So, capital structure refers to the makeup of the capitalization or long-term capital of the firm. Okay, capital structure simply refers it is the mix of debt and equity which a company uses to finance its long-term operation. It is the mix of debt and equity which are used for the long-term operation of the company. And capital structure is the combination of different sources of capital used by an organization for its long-term operation. Okay, it is the business, it is the capital structure of a business can be measured by the ratio of various kinds of long-term loans and equity capital to the total capital. Various kinds of long-term loans and equity capital to the total capital. It is the proportion of debt and equity. It is the proportion of debt and equity. Okay, under the capital structure includes mainly two decisions. One is the type of security to be issued. The first one is the type of security to be issued, which means the selection of capital from different sources. The second one is the relative ratio of security. The relative ratio of securities, which means what proportion of each security may rise. First one is which security may be selected. The second one is what its proportion. These two are the important decision under the capital structure. Okay, these two decisions are very important in every business organization because different sources of capital have different risk and return. Certain sources are more costly but lesser risky. Others are lesser costly but more risky. Okay, so the capital structure decision is very important financial decisions. Okay, on the basis of the decision criteria adopted by the management, there may be four fundamental patterns of the capital structure. That are, the first one is equity share only used equity shares of the long term operation. The second one is equity shares and debentures. Equity shares and debentures. The third one is equity shares and preference shares. Then the last one is equity shares, preference shares and debentures. These are the four patterns are used by while adopting the financial structure or capital structure decisions. Okay. So, while selecting the mix of capital, a proper planning is required. That we can call the capital structure planning. What is capital structure planning? It means estimation of the requirement of capital. It is the estimation of requirement of capital and deciding the best mix of different sources to be used in raising the estimated capital. Decide the best mix of different sources. First one is estimation of requirement. The next one is best mix of different sources to be used in raising the estimated capital. The planning is made after estimating how much capital is needed to the organization. The planning is made after estimating how much capital is needed to the business organization. Simply, it refers to selecting a desired debt equity mix. Simply, we can mean that it refers to selecting a desired debt equity mix. Okay, proper capital structure planning helps to maintain optimum capital structure. What is optimum capital structure? Optimum capital structure means the overall cost of capital is minimum. The overall cost of capital is the minimum and the market value of the firm is maximum. That level of mix of capital we can call optimum capital structure. While planning the capital structure, greater care should be taken in deciding the debt equity mix. Okay, then our next topic is methods. We can use different methods of capital structure planning. Different methods. There are commonly three methods are used to plan a firm's capital structure. They are first one is EBIT or EPS analysis. Second one valuation method. Then last one cash flow analysis. These three methods are used to plan a firm's capital structure. Okay, from the first one, EBIT means earning before interest and tax. EPS means earning per share. This method is used to analyze the impact of debt on earning per share and risk. The impact of debt on earning per share and risk. In other words, it determines the effect of leverage. This is the method to examine the effect of financial leverage. Financial leverage arises when they use the debt and preference capital in business. When the company use debt and preference capital in business, their financial leverage may arise. And this method is used to analyze the value of earning per share with a different level of EBIT. That means earning before interest and tax under alternative financial plans. This is the first method. Then second method is valuation method. What is valuation method? Here, the valuation method comparing the debt to capital to the value of equity shares. Debt to capital and value of equity shares. This means debt should be used up to the point where the weighted average cost is at minimum and the market value as maximum. Okay, it means the debt should be used up to the point when the weighted average cost of capital is at minimum level and the same point the market value is at maximum. This is the valuation method. Okay. Then the third one, the last one is cash flow analysis. This method is used to assess the firm's ability to meet debt obligation without any difficulty. This method is used to assess the firm's ability to meet debt obligation without any difficulties. Therefore, expected future cash flow should be carefully examined before utilizing the debt. We can use cash budget method or net cash flow method for analyzing cash flows. Okay, these are the three methods or approaches of capital to plan capital structure planning. Okay, let's move on to the next topic, that is factors influencing capital structure. There are many factors that are influenced while planning a proper capital structure. What are they? The factors are mainly classified into two. First one is internal factor, then second one is external factors. Let's see what are the internal factors. Okay, the first one is profitability of the firm. The first one is profitability. Before planning the capital structure, the firm should keep in mind the objectives that are maximum or maximization of shareholders' wealth and the selection of the combination which give high value of earning per share. Here two objectives, that is maximization of shareholders' wealth and maximize the value of earning per share. That is the profitability of the firm. Then second one is liquidity. What is liquidity? The liquidity of the firm should be considered while planning capital structure. It includes the analysis of cash inflow and cash outflow. If the cash inflow is more than cash outflow, the firm can opt debt finance. It is the analysis of cash inflow and cash outflow. Okay, if the cash inflow is more than cash outflow, the firm can opt debt finance. The firm can meet the obligations of debt finance. Okay. Then the third one is nature of business. Nature of the business. There are two type of business, that is manufacturing company and trading company. In manufacturing company, we know that company required more investment than trading company. Manufacturing company required more investment, huge investment than compared to trading company, and need fixed investment. But trading company do not have any huge investment or any fixed investment. It needs current asset, its operations. Okay, this is the nature of the business. Then next one is the size of business. By size of business can classify into three, that are small business, medium business, large business. In small business, it is deferred to raise long-term debt. They opt share capital or retained earnings for the operation of that company. Large company require huge investment, so they opt long-term capitals or long-term bonds or long-term loans. They opt for the long-term operations. Okay. Then under medium term business, they procure different capital from different sources. They use different capitals. They use loans, they use debentures, they use equity capital, they use preference capital. They use different capital from different sources. Okay. The next factor is period and purpose of financing. Period and purpose of financing. Under long term financing, equity capital is the best choice, and the debt and preference shares are preferable medium term finance. Long term financing used equity capital is the best choice, and medium term finance, debentures and preference shares are best choice. Okay. The next one is the asset structure of the company. It means the fixed asset and current asset of the firm. It includes fixed asset and current asset of the firm. If the company have more fixed asset, it will use more debt and preference capital. If the company have more current asset, it may use more equity capital. Okay, it is tell about the total current asset and fixed asset of the company. If the fixed asset is more, they can use debt and preference capital. If the current asset is more, they can use more equity capital for the capital raising. Okay. Okay, students, these are the important internal factors which are affected in the capital structure planning. So let's see what are the external factors of the capital structure planning. The first one is conditions in the capital market. Conditions in the capital market. It includes type of security issued, the rate of interest on debentures, and rate of dividend in preference shares, etc. Okay, these are the main conditions in the capital market: rate of interest, rate of dividend, type of security, etc. Okay. Then the second one is cost of financing. Cost of financing. It is the selection of cheapest source of finance to maximize return. The cheapest source of capital is debt capital. It is the selection of cheapest source of finance that will give maximum return. Generally, we can say that debt capital is the cheapest source of finance. Okay. Then the last one is legal requirements. The firm should consider the provisions and laws of the government and norms of SEBI, then the norms of financial institutions, then norms and provisions of stock exchange, etc. before making the plan of capital structure. These are the external factors considering while fixing the capital structure mix. Okay. Then move on to the next topic, that is optimum capital structure. This is the last topic in our chapter. What is optimum capital structure? Okay, optimum capital structure is every company tried to make an optimum or most appropriate capital structure of the firm. The main objectives of capital structure is maximize the value of the firm or shareholders' wealth and minimize the overall cost of capital. So, the capital structure which maximize the value of the firm and minimize the cost of capital is called optimum capital structure. It is the best or most economical capital structure. It is the best or most economical capital structure. Okay, the optimum capital structure try to minimize the weighted average of cost of capital, total cost of capital, and maximize the value of the firm or shareholders wealth. It is the mix of debt and equity that maximize the value of the company and minimize the cost of capital. That mix we can call optimum capital structure. Okay, and it is the mix of debt and equity that maximize the value of the company and minimize the cost of capital. And the optimal capital structure always try to minimize the weighted average cost of capital. Okay, it is the strike the balance between risk and return. Then next one is essentials of a sound or optimum capital structure. What are the essential for the optimum capital structure? First one is, from the meaning we already learned about, the optimum capital structure helps to minimize the cost. The point is also that point. The first one is minimum cost of capital. Second one is minimum risk, then maximum return, maximum control, safety is needed, simplicity, flexibility, attractive roles, commensurate to legal requirements. These are the important essential for a sound or optimum capital structure. Okay, students, these are this all about our topic today. Okay, I think all of you understood what I discussed here. uh, okay, thank you very much.